In this video, we're going to go through our adjusting journal entries. The reason we have to do adjusting journal entries is because companies work on the accrual basis. This is GAAP, generally accepted accounting principles. What the accrual basis says is that any revenues and expenses are recorded when the event occurs or happens. So you're going to write the word incur. And a lot of people tend to not understand quite what that means. So if it happened, whether we get money for it or not, that is a revenue or expense. For example, if you go to the doctor, you have your visit, you don't pay right away, that's okay. It's still revenue to that doctor because he already performed that service. It happened. It incurred. In a cash basis accounting system, you record those revenue and expenses when the cash is received. So you might have already done the work, but you wouldn't record it right away. You only record it if you receive the cash. So go ahead and review some of these principles which help explain that concept. And I'm going to walk through the actual adjusting entries that you're going to do at the end of the period to make sure that your revenue and expenses are up to date. This is a really good example here in your book. I would appreciate if you kind of write this down in your notes so that you have easy access to that come test time and homework time. It'll be really useful to you. But what I do want to walk through with you are examples of these adjusting journal entries that you're going to see. So let's start with a prepaid expense. Prepaid expenses are assets, something we own or control. For example, if you have an apartment, you usually pay rent at the beginning of the month. That's for the whole month, or sometimes you pay it for like 6 months in advance. So this example of this would be prepaid rent. It's not an expense until it's used. So these are expenses that you've already paid for, but they have not yet incurred. So expenses that you paid, but not yet incurred. So when this originally happened and you paid for this, remember we record that we actually have an asset when we pay for it. So we would record a debit to our prepaid rent and a credit to cash. But our adjusting journal entry for this is going to be actually recording the expense. So I would record that rent expense, and I would then credit my prepaid rent. So I'm lowering the amount of the asset that I had, showing the use of that rent by debiting my rent expense. Same thing with unearned revenue. This is a liability. And what this is saying is that I received some cash, but I did not actually do the work yet. So you receive cash, for services not yet done. So maybe you need to, like, I don't know, get a new roof on your house or something, and you have to pay for it in advance. That would be unearned revenue for that roofing company. When this originally happens, we are going to record that we received cash and increase that liability by crediting my unearned revenue. But then at the end of the period, when we want to do that adjusting journal entry to show how much we've actually earned, we're going to then debit the unearned revenue, decreasing that liability, and we are going to credit our revenue. Remember, the point of these adjusting journal entries is bringing revenue and expenses up to date. So in these two examples, you can see we're recognizing either the expense or the revenue on our books. Speaking of our revenue, let's talk about an accrued revenue. This is different than unearned revenue because we've actually earned it, but we haven't received it or recorded it. So this is something maybe we have performed a service, but then we're going to send them a bill later. We just haven't done that yet. So when we do the adjusting journal entry for this one, remember nothing has been recorded yet. So we're going to debit accounts receivable and we're going to credit our revenue. Accrued expenses are the same concept as accrued revenue. We've had these expenses, they have been incurred, but we have not recorded it yet. So these expenses have incurred, but they have not been recorded. The most often that you're going to see this concept is in your wages. So people have worked, maybe they get paid every Friday, but our year end is on Wednesday. So they've worked Monday, Tuesday, Wednesday and haven't gotten paid yet. So when we do that adjusting journal entry to show that those wages have been earned, we would debit wage expense and credit that wages payable. And supplies. Make this a little bit of a different color. Supplies expense. So remember, when we buy supplies, that's an asset. But a definition of an expense is what we've used. So supplies, when we need to do that adjusting entry, we're recording those supplies that were used and not recorded as being used. So when we originally purchased supplies, this is an asset, we debit that asset. So typically what we want to do is see how much at the end of the year is left. So we're going to make this adjusting journal entry. We're usually taking our beginning balance. We're going to add in any additions like purchases. We're going to subtract our ending balance, and that's going to give us the adjustment we need. Remember, supplies are things like pens, markers. We're not going to record that every single time we use one. We're just going to go in at the end of the period count how much we have left, and make that adjustment. So to make that adjustment, we're going to debit our supplies expense. And credit our supplies. And then we have depreciation every year, every period on our assets, because this shows the use of an asset. And because of that historical cost principle, we do not adjust the value of our asset on our books. We're going to create an accumulated depreciation account. This accumulates, adds up all of the depreciation that we have recorded every year. So we're going to debit our depreciation expense and credit this account called accumulated depreciation. This account is a contra asset account. And what that means is that it attaches itself to whatever asset it's talking about. So if we're depreciating equipment, this accumulated depreciation would attach to the equipment, but assets have a normal debit balance. This will have a normal credit balance. So it's lowering the value of my asset without changing the asset value in the books, because we need that historical cost principle to show that. So read up on that, and if that concept doesn't make sense, we can talk about that some more. Some notes I want you to record about adjusting journal entries. These are just little helpful tips to make sure you're doing it right. You'll notice your adjusting journal entries never use cash. That account's never hit. The other thing I want you to notice is that it always has one income statement account and one balance sheet account. So these are some just quick tips to make sure that you're on the right track. So again, we never use cash. You can see all in the red. These are our adjusting journal entries. And each one has an income statement account and a balance sheet account. So they all either hit revenue or expense, and then an offsetting balance sheet account. For example, accounts receivable. That's my balance sheet account. Revenue is income statement. Expenses, income statement. Payable is a liability, goes on the balance sheet. So you can kind of just check yourself with that to make sure you're on the right track. One other thing I want to just go through with you real quick is some of the examples of actual journal entries. So if these are just an example of each one, you're going to see these often, so I want to make sure you have an example of them. If an insurance policy shows that some coverage has expired means used. If it's expired, that means we've already had it under our prepaid account. So we would debit our insurance expense and we would credit our prepaid insurance. For that $2,500. So this is the inventory account. It shows that we have $2,900 available at the end of the year. What we need to do is come down to our unadjusted trial balance, find our supplies. We see that we have $8,200 in there currently. So I need to take my current balance, beginning balance, that probably includes my additions, subtract my ending balance, which they tell me is $2,900, which gives me my adjustment amount of $5,300. I'm going to debit supplies expense and credit supplies. Depreciation, I debit that depreciation expense, credit accumulated depreciation. Then we have on November 1st, the company agreed to provide 6 months of service for a monthly fee of $2,700. Payment was received upon the agreement. So if the company agreed to pay 6 months of service, we already got all this money. What we need to do is take our unearned revenue account, debit that amount, and credit our revenue. So it was a monthly fee of $2,700. We're looking at 2 months here, so that's $5,400. On October 1st, the company agreed to perform a monthly service of $1,000 a month, payable at the end of the project. So again, this is something we've been doing every month, but we're not going to send the bill until later. So I need to debit accounts receivable, credit my revenue for $3,000 because it's 3 months. Here's my wages. So I'm going to debit my wage expense, credit my wages payable, and it's $120 per day. We have to accrue 3 days, and we have 2 employees. So that should equal $720. And then the last one says the balance in the prepaid rent account is for December. I come back down, I look for my prepaid rent. It's right there. It's $3,200. And that would be a rent expense. And I'm going to credit that prepaid rent. And the fun part, once you get all those journal entries in, we're going to start with our unadjusted trial balance. And then we're going to go ahead and post each of these adjustments in the adjustment column to get to my adjusted trial balance. And then this part is what's used to make our financial statements. So, remember, cash is never affected. So I can just carry that over to my adjusted trial balance. Then I have to go through and post each and every one of these. I have insurance expense and prepaid insurance for $2,500. So my insurance expense is a debit. My prepaid insurance is a credit. And I would do this for each and every one of them. I've already filled this out, so for the sake of not scrolling back up and down, I'm going to fill in the numbers here. You can do that and double check to make sure you got it all right. And then we can flow through everything. So again, you're going to post in each of these adjustments. Prepaid rent, 200, 800. Unearned revenue. I have to check my unearned revenue numbers. 5,400. Common stock I didn't touch. Retained earnings didn't touch. Service revenue. And so for my, that's in the wrong spot. For my revenue account, because that's hitting both of these two, I just added them up because there's only one line to put those in. And then I'm going to just put in the rest of my numbers here. So then what you do to get to that adjusted trial balance is you're just going to bring all of these numbers over, kind of like finding the balance in your account. Accounts receivable will have a debit balance now of $3,000. Your supplies should now have a debit balance of $2,900. Because I have a debit here, a credit here, which leaves me with a debit. Prepaid insurance, same thing. I have a debit here, a credit in the adjustments, which leaves me with a total debit balance of $9,700. Prepaid rent, I've used it all up, which means I have nothing left, either debit or credit. Some of these accounts I haven't touched, like equipment. Now accumulated depreciation, I'm increasing, so it's 46. Accounts payable, I didn't touch. My salaries payable. My unearned revenue, I have a credit there of $13,500. But I'm going to debit $5,400, which leaves me as a credit of $8,100. The common stock doesn't change. Retained earnings doesn't change. Service revenue, I'm adding the $159,300 plus the $8,400 for a credit of $167,700. And then these other numbers I'm just adding together to get my totals. Rent expense. Now, because we've went through and added, hopefully posted everything we were supposed to, then if I add my debits and credits together, They should come out to, should hopefully come out to 4,920. Now these two will equal each other. Total debits, total credits, those two will equal each other. It's a great practice to get into, to add those together, just to make sure you've posted everything before moving on. It's just a double check for yourself. Give this a try in your homework and let me know if you have questions.